The market has been on a massive bull run over the last year. It's been difficult to not make money. Pretty much everywhere we look, we see stocks deeply in the green with the exception of one sector, and that is healthcare. If we look at the S&P 500 over the last year, it's up by about 18%, but if we look at Vanguard's Healthcare Index Fund ETF, it's down by about 9%. So we're talking about a stark difference between the S&P 500 versus healthcare stocks in general. Now, what's so interesting about this is the United States loves healthcare. If we look in the 1990s, employment was dominated by things like manufacturing and retail. But if we look as of 2024, the top employer in the vast majority of states is healthcare. But what's interesting about this is investors seem to be fleeing from healthcare stocks right now. We recently saw the largest weekly outflow from healthcare stocks since June of 2020, so the most selling of healthcare stocks in nearly 5 years. And while the vast majority of stocks seem to be trading at a premium compared to how they've historically traded, such as information technology, consumer discretionary, industrials, there's only 3 sectors trading at a discount compared to how they've historically traded. That'd be real estate, that'd be healthcare, and that would be energy. The consensus forward 12-month PE valuation for the healthcare sector is currently sitting at about 16. Now, let me show you what's interesting about this. Using ticker data, I auto-imported stock financials directly into my spreadsheet on 5 healthcare stocks that I think are particularly interesting right now, and each one for various reasons. But what we can see is 4 out of these 5 stocks have a PE ratio that is significantly lower than their 4-year average. UNH stock, currently with a PE ratio of just 11.76 when their 4-year average is 26.61. Look at Merck, 12.31, which is low, but not a good comparison to their 4-year average, which is a little bit distorted. But then we have Eli Lilly. This one's really interesting because the current PE ratio, yes, lower than the 4-year average, but it's still extremely high. Why is this the case? We'll touch on this here in a little bit. And then we have Novo Nordisk, a stock that I recently added to my portfolio with a current PE ratio of about 19.43 when their 4-year average is as high as 34.64. Not only are the valuations interesting for a few different reasons, but the dividend metrics are actually quite impressive. We can see the first 3 stocks on this list have yields anywhere from about 3% up to about 3.8%. That's a pretty solid starting dividend yield, but when you combine it with the fact that these stocks are growing their dividends at a very healthy rate, they become quite a bit more attractive from a dividend perspective. Look at Eli Lilly. 5-year dividend CAGR of above 15% with a low starting dividend yield, and then we have Novo Nordisk with a starting yield of around 2.25%, but rapid dividend growth of above 18%. These companies all have very healthy levels of return on invested capital, which remember is an indicator of a competitive advantage. And the gross profit ratio for all these stocks is quite nice. Now, UNH is fundamentally different from these other stocks because it's a healthcare insurer for the most part, so the gross profit ratio will look a bit different, but overall for the stock sector, it's quite good. So is there a massive opportunity with healthcare stocks right now? That's the question. What does it mean for a stock to be undervalued? Well, it means the stock is trading below its intrinsic value. Now, what do we know? Over the long term, growing revenue, growing earnings, growing free cash flow is what drives share price appreciation. And here's what's interesting about these healthcare stocks. For example, if we look at UnitedHealth Group on Forecaster, you can see as the sales for the business have grown over the past few years, the share price has grown, but then we had the huge sell-off. If we look at Merck, we can see the same story. The share price has been following the sales growth of the business over the last few years, but then we had a huge sell-off. And then if we look at Novo Nordisk, again, we can see massive share price appreciation over the last few years, driven by top lines and bottom lines growing at a high rate. But again, we've seen a huge sell-off. Why does there seem to be a disconnect between the earnings, between the revenue and the share price with these businesses? Each of these stocks has a different story, so let's go ahead and discuss. Let's briefly touch on UNH stock to start. Now, this is a company that's obviously been in the news a lot lately, and it's getting ready to report a key earnings report that's going to be absolutely pivotal for the business. I'm going to go ahead and play this clip from CNBC so you can see the main reason the stock is currently down.
We also got some breaking news right now from UnitedHealth. Want to get straight over to Bertha Coombs, who's got that news. Good morning.
Andrew, UnitedHealth shares falling at this hour as the company reveals in an 8K that it is under investigation by the DOJ on both civil and criminal charges with regard to its Medicaid practice. The company telling CNBC that it proactively went to speak to the DOJ, given all of the reports, many of them coming from the Wall Street Journal, about the investigation going on. The company does point out that it has launched an internal audit to look at its practices in Medicare as well as in its PBM pharmacy benefits unit. They do not expect that internal report, will be ready when they report earnings next Tuesday. It will likely take through the third quarter in order to come with that, but they are very confident that they will be able to meet these charges. They have noted that they did win a special master in a separate case last March, recommended that the DOJ's case not go forward when it comes to fraud billing. Back to you.
So UNH is currently in the midst of an investigation. Now, one of the things that's interesting about this is if we look at what's been going on with Congress buying and selling of UNH stock, it's actually seen for the first time in a long time more buying from Congress members than selling. This is not typically the case for UNH stock. On top of this, insiders are buying UNH stock as well. In fact, 2025 has seen more insider buying than UNH has pretty much seen in the last 15 years. Now, this obviously doesn't mean that UNH stock is in the clear, but I do think that's all a good sign. And what's interesting is if we run UNH through a sensitivity analysis, what we can see is the estimated earnings growth of this business is around 15% through the year 2029. So let's just go with that projected EPS growth rate of around 14.75%. Then we can see the average PE ratio of UNH over the last decade is about 23 versus the trailing 12 months, a little bit below 12. So let's assume it just recovers a little bit, up to 14. So basically very little PE expansion. What we can see is there's massive upside to this stock. If that PE ratio jumps all the way back up to around 21, the returns look absolutely phenomenal. So it's clear there's massive opportunity with UNH, but investors are waiting to see what will become of the DOJ investigation. Now, let's touch on AbbVie for a moment. This is an interesting one because this is the only stock on our list who has a current PE ratio higher than its 4-year average. Now, historically, AbbVie has been a pretty attractive dividend stock. If we jump over to the dividend breakdown sheet, we can see the starting dividend yield sitting at about 3.4%, a healthy free cash flow payout ratio, and they've been growing that dividend at a healthy rate with a very nice 10-year dividend CAGR of above 12% and a 5-year dividend CAGR of about 6.51%. But here's where things get interesting for AbbVie. Free cash flow was growing at a very high rate over the past decade, but it peaked in 2022, declined in 2023, declined again in 2024. So what's going on with AbbVie? If we jump over to Forecaster, we can see sales have remained relatively stagnant, a little bit of a drop in 2023. But if we jump over to the stock screener, let's take a look at what's been going on with their earnings. The data will load in thanks to ticker data, and look at the EPS for AbbVie. 2021, 648, 2022, 665, and then it fell off a cliff. 2023 fell all the way down to 271, and 2024, $2.40. Why did this happen? Well, we have to fundamentally understand these different healthcare businesses. We know UNH is in the insurance segment, but what about these other 4 stocks? These are pharmaceutical companies. What does this mean? What do we need to be looking for? When it comes to pharmaceutical stocks, the key word is pipeline. What's in their pipeline, and how is their pipeline going to change? Well, when it comes to AbbVie, their key drug for quite some time was called Humira, and this drove a lot of top and bottom line growth for AbbVie. But these drugs typically have patent expirations, and their Humira patent expired in January of 2023. And look at what happened to those earnings. That's the reason it dropped off so much. Now, despite this, we can see AbbVie's share prices actually continue to climb. Why is this the case? Well, if we jump back over to the sensitivity analysis, let's plug in AbbVie and look at those projected EPS CAGRs. Well, what we can see is the projected EPS CAGR for AbbVie over the next few years is about 12%. In fact, the estimated EPS from analysts in 2025 is $11.98. That's a significant jump up from where they were in 2024 when it came in at $2.40, and even 2022 when it came in at $6.65. Again, why is this the case? It's all about the pipeline. If we look at AbbVie's pipeline, we have to remember there's 4 different phases, and typically if a drug makes it to phase 3, it's likely to hit the market. But there's 2 drugs in particular that has investors particularly excited, and that management has stated will drive massive top and bottom line growth. And that's going to be Skyrizi and Rimvoq. Excuse me if I didn't pronounce that right. But they recently increased the guidance for both of these drugs, and they stated that by 2027, combined, these drugs could be doing more than $27 billion in revenue. Now, for reference, if we jump over to our profitability tab, We can see last year AbbVie did about $56.3 billion in revenue, so those two new drugs alone are adding about 50% to their top line. This is why it's so important to pay attention to pharmaceutical stocks pipeline and look at the guidance that management is giving with these drugs, and also pay attention to what phase it's in. These drugs passing these trials can be major news for these different pharmaceutical stocks. So yes, net income has dropped in the last couple of years, but the share price has continued to climb higher. But the reality is, this isn't a disconnect from the fundamentals, the market is just forward-looking. And so this is a scenario where the PE ratio would actually lie to us, because when we look at the prior year's earnings, like we've already seen, they were quite low, but the share price continued to climb higher, which led to a very high PE ratio. This is why we have to actually understand the story behind each of these businesses, because we're looking at a high PE ratio, a declining 5-year EPS CAGR. If you just looked at these two key metrics, you would think this is not a business that you want to look at. But when you look at the pipeline and look at the guidance that management is giving, all of a sudden you can see why the share price has continued to increase while net income has actually decreased in the last couple of years. So if we look at AbbVie from a sensitivity model valuation, these pharmaceutical stocks certainly a little bit more difficult to value, but let's just go with the average EPS CAGR projected at about 12%. Now we need to apply our PE ratio, and this is where things get a little bit more difficult because the PE ratio for this stock jumps around all over the place. But one of the things we can see if we jump over to Seeking Alpha and look at that PE ratio on a non-GAAP basis, it's sitting about 18.58, forward-looking about 15.93. Both of these are actually a little bit higher than their historic average. If we look at the GAAP price to earnings ratio on a forward-looking basis, it looks like their 5-year average is actually about 23.18. This is the number we want to pay close attention to because that's what we're looking at on our spreadsheet. So let's assume a PE ratio a little bit lower than that to be more conservative. Maybe it's about 19.5. What type of results do we get? All of a sudden, we're looking at a very nice market-beating returns. By the year 2030, a total return of 116%, which would be a compounded annual return of close to 14%, which, keep in mind, this stock is a great dividend payer with a starting yield of about 3.4% and a 5-year dividend CAGR of about 6.51%. Now we come to Merck. Merck is a stock that has a very healthy EPS CAGR over the last 5 years, close to about 12%. That's really nice earnings growth, combined with a very low current PE ratio of just 12.31. But despite this, we can see they're down year to date by about 14.5% and over the last 3 years, down by about 6.43%. So we're essentially seeing the exact opposite story of AbbVie. Better earnings growth, better valuation, but they're actually selling off. So what's the story behind Merck? Now, to start off, we can see they've grown dividend at a healthy rate with a nice starting dividend yield, actually the highest on this list at about 3.78%. And this is another one where if we look at Forecaster, it seems like there's a disconnect between the fundamentals and the share price. I mean, at one point, they were trading as high as about $133 per share, and they've sold all the way down to around $84 a share. Meanwhile, sales have continued to grow higher. Well, with Merck, it really boils down to one thing, and that's keytruda. It's estimated that keytruda makes up around 46% of the total revenue for Merck. Now, if we go and jump over to the stock screener, let's see exactly what that looks like. We can see in 2024, EPS was about $6.74, and if we look at the revenue, it was about $64.1 billion. So almost half of that came from one drug. Now, that's not necessarily uncommon for these pharmaceutical stocks, but here's the problem. Merck is set to lose its patent on keytruda by the end of 2028. And at the moment, investors don't seem to be impressed with the pipeline after 2028. For example, if we jump over to Seeking Alpha, look at the earnings estimates. You can see pretty solid earnings growth is projected for the next 2 to 3 years, but then they're projecting negative earnings growth. If we jump over to ticker data estimates, we can see we plugged in Merck and look at the next few years. Again, through the year 2027, earnings are projected to grow at actually a pretty healthy rate. But then 2028, negative growth. 2029, negative growth. Investors aren't convinced there's enough in the pipeline to make up for losing that keytruda patent. So this makes valuation for Merck pretty unique, because so far, like we've seen, the company has continued to increase revenues. But as we get closer to 2028 and there's still not enough in the pipeline to drive future growth, we can see the stock is selling off. In fact, if we look at 2025 guidance that management recently gave us in their earnings report, we can see revenue is projected to be at pretty much the exact same as the previous year. So again, this makes valuation with Merck a pretty unique situation. They still have about 3 years to figure out their pipeline, to see if there's potential acquisitions they could make to drive growth before they lose that keytruda patent. And what's interesting, and again, if we jump over to the political tab here, we can see Merck has actually been a widely bought stock in the most recent quarter by members of Congress. Very much more so than pretty much any other quarter in the last 5 years. So yes, no doubt, when we look at Merck, earnings have been growing at a good rate over the last 5 years. The valuation, at least on a backwards-looking basis, looks good, and the dividend's been growing, and the starting dividend yield is inching closer to 4%. Return on invested capital is phenomenal, above 20%, which is what I love to see, and the gross profit ratio is very strong at 76%. But like all these other stocks, the story is about the pipeline. And right now, there's a lot more questions for Merck than there is for AbbVie, for example. Now, finally, that leads us to Eli Lilly and Company and Novo Nordisk. While the metrics for these two companies look quite a bit different in a few different ways, these companies are in the middle of a quiet battle. Yes, Novo Nordisk has grown earnings at just a tremendous rate over the last 5 years, significantly faster than Eli Lilly, and the valuation, at least on a PE ratio basis, looks significantly more attractive. In fact, Novo Nordisk also has a better starting dividend yield, better dividend growth. Return on invested capital has been better, and their gross profit ratio is higher. And in fact, they have the dominant market share in the GLP-1 market. Now, this is a market that's projected to grow at a very high rate over the next few years. In fact, I've seen many different projections, but this is one that's estimating the compounded annual growth rate through the year 2030 will be about 18%, and I've seen many estimates even higher than that. So it's clear Novo Nordisk is set to benefit from that market growth. But again, when it comes to these pharmaceutical companies, it's about the pipeline. And Eli Lilly has something up their sleeve, and it's called tirzepatide. We can see this drug received approval from the FDA in December of 2024. And this is a drug that will compete with Novo Nordisk's weight loss drugs. Now, when we look at Novo Nordisk, we've seen a massive sell-off over the last year, down around 50%. Meanwhile, net income continues to grow. The sales for the company continues to grow. But if we look at Eli Lilly, yes, their sales are growing, their net income is growing, but they haven't seen a sell-off. It seems that investors are starting to believe that Eli Lilly is pulling away from this race, but here's what a lot of people seem to be missing. Eli Lilly and Novo Nordisk are dominating this market. There's really no other competitors. And right now, Novo Nordisk has over 50% of the market share. In fact, Novo Nordisk is currently sitting at about 62% market share, while Eli Lilly is sitting at 35%. But here's what's so interesting to me. When we look at the financial outlook for Novo Nordisk, we can see they're still expecting sales growth anywhere between around 13% to 21%. Operating profit growth between 16% and 24%. So even if Eli Lilly is slightly cutting into that market share, Novo Nordisk is still growing at an extremely high rate. And so from a risk versus return perspective, I think the company does look attractive. For example, let's look at them. To start, we can see that the projected EPS CAGR through the year 2029 is about 13%. 13% EPS growth. Okay, let's go ahead and apply that, 13.04. Now, the average PE ratio for this stock over the last decade is sitting around 27.3, but for the trailing 12 months, it's sitting at just 19. So again, I don't want to be over optimistic, but let's assume it just sits at about 21.5, still significantly lower than its average over the last decade. All of a sudden, you're looking at, again, very attractive returns by the year 2029, 2030, around a 130% return with a compounded return of nearly 15%, not including dividends, which again, they had a nice starting dividend yield of around 2.25% and do reward their shareholders by rapidly growing that dividend. Now, what about a more bearish case scenario? Maybe Eli Lilly takes more market share than expected, and so that PE ratio declines, and maybe it's sitting at just 18, and the EPS growth rate is only about 11%. This is what I like. You're still looking at attractive returns. This would be a compounded return of just a little bit below 10%. Now, I do want to point out that on the flip side, Eli Lilly will grow earnings at a very fast rate. If we look at that projected EPS CAGR, it's sitting close to 23%. 2024 EPS came in at $11.76. They're projecting that by 2029, it'll be $49.55. That right there is the exact reason that this stock is trading at such a high price to earnings multiple. So what have we learned? Yes, healthcare stocks are trading at one of their lowest valuations that we've seen in years. But not all healthcare stocks are created equal. They don't all have the same story. In fact, each of these stocks has a very unique story going on right now. With that being said, I do think there's opportunity with some of these stocks. Again, at the end of the day, we're looking for a disconnect in the fundamentals versus the share price, but not just on a backwards-looking basis, on a forward-looking basis as well. We have to understand what's going on with the pipeline for each of these stocks. What does the potential earnings growth look like? What does the certainty versus the uncertainty with that pipeline look like? And then, of course, with UNH, what's going to go on with the DOJ? So go ahead and let me know what you think of each of these companies in the comments down below. And like always, don't forget to like and subscribe to the channel.